Are you a first-time home buyer and curious about FHA loans? There's a lot of misconceptions about FHA loans from buyers and sellers from other lenders you might have talked to. In today's video, I'm going to talk all about FHA loans, what they are, what they're not, all the ins and outs that you need to know as a prospective home buyer. By the way, my name is Emmett Dempsey. I'm a mortgage broker and owner of Treasure Coast Mortgage here in Port St. Lucie. If you have any questions about the home buying process, how much home you can afford, or any questions about FHA loans for your special situation, all my information is in the description. You can go and book a call, shoot me a text, shoot me an email. Let's talk. I'd love to help you guys. Okay, what is an FHA loan? It's basically, if you wind back into history, the FHA is administered by the Federal Housing Administration. That's what FHA stands for, Federal Housing Administration. And today it's managed by the Housing Urban Development, or HUD. The FHA was created in the wake of the Great Depression with the Housing Act of 1934. And the point of that act was basically to allow employment, to increase home construction, and to solidify the housing market in the wake of the Great Depression. Today, the FHA is still around. It's administered by the Housing and Urban Development. Now, keynotes is the FHA does not make any loans. FHA loans are made by lenders. The FHA creates the rule book, and then the lenders execute that rule book. As a football coach, so basically the players are the lenders, and the coach is the FHA. Okay, what about down payments? So basically, an FHA loan has a 3.5% down payment minimum. So it's key to note that your down payment is just one portion of your cash to close. There's your down payment, closing costs, and prepays. And for an FHA loan, it's 3.5% minimum down payment. And now you have to show that you can make it yourself. So you can also get a gift for it. There's also some down payment assistance programs, like here in Florida, we have the Hometown Heroes program. We have other programs here we call Chinoa, and as well as other ones from other lenders that we have that will fund your entire down payment. But effectively, your down payment minimum is 3.5%, whether you get it from yourself, or a gift or family member, or you get it from one of the many community programs I know here in Florida, St. Lucie County. There's your SHIP programs. There's a lot of down payment money out there, and so definitely kind of search around for that down payment money if you can't make it on your own. Okay, so what are the credit requirements for an FHA loan? That's going to depend on the lender that you talk to. For me, as a broker, I have multiple different lenders. The FHA minimum is 500 FICO. Okay, so just so you know, that we administer based off of FICO versions 2, 4, and 5, not the Advantage model, but what your FICO score is. That we go by your low middle FICO score. So the middle FICO score that we go by is 500, but between 500 and 579, you have to put down 10%. Okay, so from 580 above, it's going to be 3.5%. We talk about down payments, but if your FICO is below 580, you put down 10%. Okay, so it really is going to depend on the lender that you talk to. Generally, sometimes as low as 600, as low as 640 is the minimum. Some are 580 minimums. So you have to ask them what are your minimum FICOs for FHA. But for us, I've done several loans from below 579, 10% down. It just worked out for them. They either got a 401k loan or they're buying the house they're living in. So it's just the numbers made sense. So buy 10% down. FHA loans are known for being more lenient when it comes to lower FICO scores versus a conventional, whereas anything on a conventional below 700, you have risk-based pricing. But an FHA loan is insured, so they can offer better rates at lower FICO scores. All right, so what are the credit events on an FHA loan? Effectively, FHA loans, like I said before, are more forgiving when it comes to derogatory events. So they're more forgiving on revolving and installment rates, and generally you can have more banged up credit with an FHA loan than you can versus a conventional. So some of the key considerations as far as collections go in general. If you have some collections that are non-medical in nature, so medical collections, they don't count those, but if you have some collections that you haven't paid and they total, even not just one big one, but also multiple ones that can total up to $2,000, we have to account for them in your debt to income ratio of 5%. So for instance, if you have $2,000 on the nose, that's $100 I have to account for. And what that'll do is that'll lower how much home you can afford. So it's important that you do your best to take care of the collections, either get on a payment plan or pay them off at closing, have a plan for that. More about credit events, basically your major derogatory items, something like your bankruptcies, foreclosures, things like that. FHA has generally a shorter wait time for a deed in lieu, foreclosure, short sale. That's a 3-year wait. Versus a Chapter 7 bankruptcy, it's a 2-year wait. And if you're in Chapter 13 bankruptcy, you can still be in the bankruptcy court, but you have to have 12 months of on time and you get the court's approval in order to apply. So I've had clients that were in a Chapter 13 bankruptcy and still able to buy with an FHA loan. So it's definitely a unique feature of it. So don't think because you're in Chapter 13 that you can't buy a house. Also, another key feature about credit is student loans. Just a recent change, it used to be 1% of the balance at all times for student loans. Like say if you have deferred student loans, and if you're an income-based repayment, even if you were an income-based repayment, I just have to count 1% of the balance. So if you had significant student loans, it could be a detriment to how much home you can afford, or even you qualifying altogether. A recent change, now it's 0.5%. So if you're an income-based repayment, it's basically cut it in half, and it's have to count 0.5% of the balance in your debt to income versus 1% if you're an income-based repayment. All right, let's go ahead and talk about interest rates. Now, interest rates on an FHA loan are generally lower than conventional loans. And the reason for that is because they're insured. So basically, everything in the mortgage business is about risk. So if the lender is taking less risk, of course they're gonna compensate you and then minimize your interest rate in order to account for the lower risk that they're having to take. Because if in case you don't pay the loan back, the government is going to insure them against loss. That's basically the way mortgages work. It's all about mitigating that risk, and they mitigate that risk with the interest rates. So an FHA loan is generally going to have lower interest rates comparative to a conventional loan. Now, the differences can change throughout. Right now in March of 2023, interest rates are in the 7s. So the gap can change from day to day depending on the interest rate environment. So definitely get a rate quote. You can go to my website tcmortgage.com and look for today's rates. You can check what today's rates are. As well as interest rates, definitely you want to shop around, but a mortgage broker like myself are going to tend to have better rates because we don't have layers of middle management, and I can shop different lenders. So you definitely want to go talk to a mortgage broker like myself. All right, let's go and talk about mortgage insurance with FHA loans. Now, FHA loans are insured, just like I was saying before, and it kept solvent by the mortgage insurance premium. So then there's two different things that you got to account for an FHA loan. Now, the FHA has what's called an upfront mortgage insurance premium, or UFMIP, and it's 1.75% of the loan. Now, that is financed into your loan. So you're going to have a base loan and then a gross loan. So basically, the base loan times 1.75% added on top of it, and that's going to be your gross loan. So that is a funding fee. Okay, so that's similar to VA, USDA. They have funding fees that fund these government programs to help keep the entire thing solvent. Okay, so that's one piece. The second piece is what's called and then the second piece is what's called the monthly mortgage insurance. Now, we just had some positive news where they lowered that. For years, I've been doing this when it was over 1%, and then for years it was 0.85%, and then they lowered it by 30 basis points to 0.55%. Okay, so basically they lowered it in 0.55%. However, unlike conventional financing, so I know the last few years we had some great run-ups in appreciation. I've had some conventional clients remove their mortgage insurance within a couple of years. However, you can't do that on an FHA loan. If you put down less than 10%, it was 0.85%. Like I said, now it's 0.55%, and it stays on for the life of the loan. If you put down 10% or more, it'll fall off after 11 years. Okay, so keep that in mind. FHA loans in general, for me personally, so keep that in mind when you have an FHA loan, that your mortgage insurance will not fall away. As far as comparative to conventional MI, generally FHA can be much cheaper for lower FICOs, which is kind of what this program is meant for. It's not meant to be your forever loan. This is mainly basically kind of your stepping stone in home ownership. And many of my clients that are first-time home buyers or had some derogatory events, came into an FHA loan, and that's exactly what my family did. Because years ago, like I've said in other videos, I filed bankruptcy, 10 plus years ago, and in my first stepping stone back in the housing industry, my first stepping stone back to buying a house was an FHA loan, because I only had a 3-year wait. I only had a 2-year wait from bankruptcy, and then a 3-year wait from a foreclosure. So that was the first time. So we used an FHA loan and refinanced out of it into a conventional and a VA, and I currently have a VA loan today. But FHA was the foot in the door to get started. What are the property requirements in an FHA loan? Basically, your FHA loan has to be your primary residence. Okay, you can't buy any investment property with this, generally, but there is a thing called house hacking that you can do that we'll talk about in a second. All right, so basically, what are the property requirements in an FHA loan? You have to use your FHA loan for your primary residence. Okay, so basically this is the house that you have to live in. You can't buy it for investment property in general. However, you can buy investment property with it in a different way. It's called house hacking. So you can buy a 1 to 4 unit house, because that's technically a single family. Residential real estate is considered 1 to 4 units. So if you can find a fourplex and use that, you can FHA loan with 3.5% down, and you can use 75% of the rent to offset that mortgage payment. So basically, if you can buy a fourplex, they only consider 100% of the debt to income on your unit, and they'll see what those market rents are and offset that and offset the cost of that into your debt to income of 75% of the rental. So not only that, so you can qualify for more of a house. It helps you qualify when you buy a 4-unit building. Duplex, triplex, fourplex. That's definitely a benefit of an FHA loan, where you can buy a pretty significant investment property for very little out-of-pocket money. So that's definitely a great benefit of an FHA loan. Condominiums, condos. Okay, so I know here in Florida, condos are a big issue. Generally, the complex itself has to be approved. In my entire career, I did one loan where the complex was approved. Generally, I know that the FHA's try to minimize that with spot condo approval. It's just, I really wish condos were easier, but generally the associations have to have good reserves, good property requirements. It kind of mirrors conventional condo financing. So definitely, if you're looking to buy a condo, you have to tread very lightly, in order to make sure that complex is approved, or you get that one unit approved, and make sure that there's a process to follow. You definitely talk to a mortgage professional that understands the process of about a spot condo approval. Also, a rule that you have to be cognizant of is called the property flip rule. Basically, 90 days is when it is. So if you're trying to buy a property and flip it with a 90-day rule, you can't use FHA financing. So if you live in an area that has a lot of renovated houses, you have to really check when that property was acquired. So on the 91st day is when you can go under contract on that home. Okay, so you'd be cognizant of the property. It's called the property flip rule. Okay, let's go and talk about loan limits. Now, the FHA, you can't get as much of the loan as you want, okay? So there are loan limits with FHA loans. So you have to definitely check there. I provide a link in the description that you can go to check the loan limits in your area. But basically, I know here where I'm at in South Florida, it's about $500,000 and change. And for years and years, it was in the high 2s, but there's still a gap. So you can have a bigger loan on conventional, which is $726,200, versus right now it's $500,000, because we're not a high cost area. If you're in areas like in Virginia, California, those are high cost areas. So you check the loan limits in your county. You can generally borrow more. Yeah. So what are the appraisal requirements of an FHA loan? Basically, the FHA, if you use an FHA financing, the house has to be move-in ready. Okay, so it can't be a fixer-upper. There's a program for that called the FHA 203K. So that's a whole other video. But generally, an FHA standard 203B loan has to be pretty much move-in ready. So what does that really mean? Effectively, you can't have major items such as exposed wiring, peeling paint, rotted wood, rotted soffits, basically obviously structural integrity things. Okay, so holes in the walls, exposed wiring, things like that, things that are obvious. But the FHA appraiser is not out to get you. Okay, and if you're a seller, or a seller or realtor listing and accepting an FHA offer, just keep that in mind. If it's not obvious, the FHA appraiser is not out to get you, and he just takes a peek in the attic. It's called a head and shoulders inspection, and looks for obvious things that talk about the health and safety. Okay? So basically, it's all about health and safety with these appraisers, and that's kind of the general requirement. So it can't be a fixer-upper. It has to be generally move-in ready. It doesn't have to be perfect or anything spotless. Just those obviously major derogatory items. Okay, let's go ahead and talk about employment. Now, an FHA loan is a full documentation loan, so you have to have, if you're self-employed, 2 years filed tax returns. If you're a W-2 employee, 30 days of pay stubs, 2-year history of W-2. Now, what would they look at? They want to see a 2-year history. Okay, so what FHA cares more about is the gaps in employment. Okay, so you can change jobs and have, if you go from one to one, especially in the same industry, there's a pattern. I always like to say that a loan is a story. So you have to tell the underwriter stories like, well, I changed this job because it was a better job, I made more money. Okay, cool, well, you understand that. But tell me your entire timeline. So that they want to see a 2-year timeline from the time that FHA case number was assigned and back 2 years. So, but what they care most about is a gap. So you can have, job. Then if you have a gap, so they really want to account for that gap, especially if it's, if you have a large gap in employment, they generally want to see you on the job for 6 months. Many times as they come to us, maybe a month or 2 before we can, qualify them FHA, it's because they had a major employment gap, not because they changed different jobs. So it's all about the employment gaps, and that's how we document the income. And then we look at, your base pay, overtime, commissions, and we do an average over those. That's why they want a 2-year length. but FHA is pretty lenient when it comes to that. Okay, debt to income ratio. So if you go ahead and check here, I did a video about how to calculate how much home you can afford, and in that video I talked about different risk tolerances. So generally, I know I've done some VA loans that are in the 60s and 70s debt to income back end, but the maximum debt to income for an FHA loan is 56.99. Not to say that that's wise or that you have to do that. I'm just saying that's possible. So that's really your budget, and whether that makes sense for you and your family to go to a debt to income that high, maybe even if it's temporary, but that's generally the maximum debt to income. Now, FHA loans are very lenient. They can go above that 50% magical barrier, whereas conventional, it's 49.99, that's it. Okay, and they allow for, even so, getting above 45 can be difficult on a conventional loan, whereas an FHA loan, over 50, as long as everything else is in order with the credit. They do a risk analysis using what's called an automated underwriting system, like you might have heard of DU or LP, Fannie Mae, Freddie Mac. They do a risk analysis based on your file. They look at your income, credit, equity, down payment, all those different things in order to come up with an assessment. So that's if you get automated approval. Now, FHA does have what's called a manual underwrite, where if you have good compensating factors, so what if you're someone who has a lot of income and then you're just not getting an automated approval, maybe because you're just out of bankruptcy, you're just barely qualifying, because these algorithms are computer systems. I mean, sometimes we weren't getting what's called an approved eligible no matter what we did, and then we got what's called a refer eligible, and you're able to get the loan with some of my investors that'll take manual underwrites, and not every lender does. I have, as a broker, I have different investors that'll take manual underwrites and take that file, kind of really, instead of just one and done and rubber stamp, they look at you, they look at everything. They look at your job history, assets, where it's coming from, and they do their own assessment and to see if you're a good credit risk in order to approve the loan outside of the normal automated underwriting system. Okay, let's go talk about seller credits. FHA loans have a robust rule with 6% of the sales price for seller credits, and you can use those to either reduce your cash outlay, your cash to close, or you can use that to buy down your rate. I know lately in this interest rate environment, I've been using them to do 2-1 buy down, 3 2-1 buy downs. You can go and check out the video I did about that. If you have any questions about the 2-1 buy down, or definitely go ahead and book a call, like I said before, link in the description. Okay, what about refinancing an FHA loan? Basically, FHA has what's called a streamline program, so you can go from an FHA to an FHA. There's a streamline program. It's generally very little cash out of pocket, and so you can streamline to a lower rate. So we're in a higher interest rate environment today, so the FHA loan you get today, if you still want to go to another FHA, there's a streamlined availability to it. Or if you go just a normal FHA to FHA refinance, they'll refund a portion of your upfront mortgage insurance premium for the next FHA loan. So it's not a full 1.75, depending on how long you've been in the FHA loan, they'll give you credit back for that. Like I said before, an FHA loan is not meant to be your forever loan. Most of the refinances that you want to do eventually is you get into an FHA loan, you heal your credit, you get some good positive credit history, and then you refinance into a conventional loan. So even if the interest rates on conventional might not be as generous as an FHA, again, not having that funding fee, FHA mortgage insurance premium, and then the monthly mortgage insurance, once your house is appreciated, that's the ideal situation. Buy the house FHA, kind of plant your flag, so to speak, and then refinance into a conventional loan. Let's go ahead and talk about seller perception. So I know during the go-go times of 2020, 2021, FHA was basically, not even talked about. So it was like cash only, then maybe conventional and a cash conventional. These days with 7% rates, you're like, okay, well, we'll think about anything and everything, right? Well, FHA perception is usually, I think, misguided. They believe that the FHA requirements, property requirements, are too tight. Another consideration might be that flip rule that we talked about. That they're a rehabber, and then they just rehabbed it, and they rehabbed it quickly. Or the FHA flip rule. So, the seller perception generally overall is negative, but I think they're misinformed. So that's why I usually will call the listing agent and say, hey, this is a strong FHA buyer. I got an approved eligible. They're pre-approved. So that's why having a good mortgage broker in your corner, if you're making an offer on an FHA loan, will work with your buyer's agent, realtor, in order to make sure your offer is passed along to the listing agent and shown in the best possible light. So that's kind of what I do for my clients. Okay, well, how do you apply for an FHA loan? Well, basically, you give me a call. So I would love to do your FHA loan. You talk to another mortgage broker like me, and to do that, you can go in the description. You can book a call with me. We can see what's right for you, whether FHA is right or another type that you might be qualified for, such as USDA or what have you. So that's how you apply for it. So basically, you know, definitely shop around. There's multiple different types of lenders. You shouldn't want to use a local lender. And again, you know, with the perception of FHA, having a local lender that the listing agent knows, it definitely helps. You know, but it's not a requirement. I've done, you know, loans all over the state, all over the country, and they look at the reputation of that particular lender. And like I said, I will call a listing agent and walk them through the system. And just that phone call alone, and just understanding that I have a professional talking to them, and it's not just some call center. There's just some kid in a call center that's a mortgage professional like myself calling. It definitely makes a big difference. If you want to learn more about FHA and the other different types of loans, YouTube wants you to watch this video right here.